The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon everyone and welcome to our Ruby webinar, Financial Governance for Not-for-Profit Organisations. My name is Bronwyn Lawson and I'll be your presenter for the next 30 minutes or so. Now before I get started though, let me say a huge welcome to you all to our Ruby webinar series. For those of you who are new to Ruby, let me tell you a little more about us. Westpac has backed Australian women from day one. Nearly 200 years ago, we had Australia's first female bank customer and bank teller and the first woman as CEO. We were the first bank to dedicate a unit specifically to the success and development of Australian women, and we call it Ruby. Ruby is a platform designed for women to educate and be educated, to gain support and give it, and to help each other prosper and succeed. We want all women to know they can be part of the Ruby community. No matter what you do, where you are, or who you bank with, we provide an opportunity for all Australian women to support and learn from each other. Our website, rubyconnection.com.au, makes that possible. It provides our members with inspirational articles, case studies, learning tools, plus opportunities for self-promotion and connecting with other like-minded Australian women, all in an online environment to suit even the busiest schedule. We've also recently partnered with Westpac's Davidson Institute to bring you our new financial education webinars. We have some great topics lined up over the coming months and I look forward to seeing you all back regularly. Now let's get into the good stuff. In Australia, there are over 750,000 incorporated not-for-profit organisations, and that number rises into the millions when you include all of the unincorporated organisations as well. Now these organisations all exist for a social purpose. These purposes are incredibly diverse, but have one thing in common. To achieve their purpose, the organisations need money. And that money needs to be efficiently managed to ensure the organisation is sustainable and effectively achieving its purpose. The effective management of money by an organisation is known as financial governance. Now before I get really good stuff, let me fill you in on how our webinars work. So with so many people joining us today, it can be noisy in the background. So we've placed you all into listen-only mode. However, it is a live webinar, so I do want to be able to answer your questions. So what I'd ask you to do is to type your questions into the questions panel. So you'll see that located over on the right-hand side of your screen if you're on a computer, or at the top of your screen as a little question mark if you're on a mobile device. So please put your questions in there as you think of them, and then I'll come back at the end of the presentation to answer those questions for you. Now, we'd also love to know what other topics you'd like to see covered in our webinars. So what is it that's keeping you awake at night? Or what is it that you're simply a little bit more curious about? So please share that with us, either in that questions panel or the chat panel there as well. Now, my final piece of housekeeping is just to let you all know that today's information is general in nature and doesn't constitute advice on your personal or your organisation's situation. We thoroughly recommend talking to your financial advisor or accountant for more detailed information that's relevant to your organisation's specific circumstances. Now we're going to cover a number of elements today, starting with why do we need good financial governance and why it's important to the organisation. Secondly, good financial governance starts with keeping good records. So what records should you keep for your organisation? And thirdly, good financial governance is not just about keeping good records, you also have to produce regular financial statements so that you and the board and anyone else that needs to know can see what's going on financially. So firstly, why it's important to get the governance right. Let me pose you a question. Why did you get involved with your organisation? Now, it's my experience that people get involved with an organisation because they're passionate about the outcomes that organisation provides to the community. So organisations operating in the social sector are established with the aim of enhancing life in some way for someone. And whether it's a charitable organisation that provides food and shelter for the homeless, an organisation that provides services in the disability sector, or a sporting club or arts organisation, the aim is to improve the lives of people in our communities. It therefore stands to reason that we want to be able to do this efficiently and over a long period of time. That is, we want to be sustainable. Therefore, understanding the regulatory framework that the organisation works within and the financial position of the organisation is critical for anyone involved in decision making, either at board level or in a management capacity. So financial governance will look slightly different for every organisation, depending on its size, structure and so on. But it's one of the most important functions because it's with good financial governance that an organisation gives itself the best opportunity to achieve its purpose. Now, a friend of mine is the treasurer of an unincorporated not-for-profit organisation that has an annual turnover of about $750,000. This organisation provides benefits to its members each year that's worth probably a couple of $100,000. It's partially tax exempt and submits its business activity or BAS statement on a quarterly basis and is audited annually. So these financial obligations apply for a number of reasons that we'll look at shortly. However, as I said, I believe financial governance is one of the most important areas of any organisation, as without good financial management and its reports, it's like running your organisation in the dark. But to bring the light back, we need good record keeping, which will assist in collating good financial reports to manage the organisation efficiently, and will support an audit that shows that the organisation is compliant with regulations. The records need to be kept, and the checks and balances you put in place will depend on the constitution of the organisation and its legal and financial structure. So you see, good financial management is about achieving the purpose of the organisation. By providing accurate, timely and understandable financial information for the directors or staff, they're better able to allocate resources efficiently and be able to recognise more quickly if things are getting off track. Now, the not-for-profit sector has a number of different government regulators, depending on the size of the organisation, the legal structure of the organisation, and in some cases its purpose. Understanding the role of each of these regulators plays and knowing which applies to your organisation is the beginning of financial governance. A key regulatory body for anything financial is, of course, the Australian Tax Office, or the ATO. Now, even though your organisation may not pay income tax, there are other regulations that you'll need to comply with. If you're a company, you'll need to comply with ASIC regulations. And if you're a charity, you'll need to comply with the ACNC, or the Australian Charities and Not-for-Profit Commission. But it's not just about the government departments. It's also, as I said, about how you structure your organisation. Now, according to the ATO, there are three main structures that are used by not-for-profit organisations in Australia. These are an unincorporated association, an incorporated association, and companies limited by guarantee. There are other structures, but these are the main ones. And it's important to understand what structure your organisation has, because this will influence which of those regulators you need to comply with. Now, this could be at a national level, like the Australian Taxation Office, but also at a state government departments, or even a combination of both. So who are the relevant governing bodies? Well, if you're an unincorporated association, you should have a constitution, which is typically set up when the organisation was set up and contains all the rules by which the organisation is run, and usually has information about the records that you need to keep and whether your accounts need to be audited or not. Incorporated associations typically will have a constitution as well and are usually incorporated or registered within the state they're based in. So it's important to be familiar with the particular state's legislation and requirements to operate, as they'll differ slightly from state to state. Now, companies limited by guarantee will typically have a constitution or sometimes called a Memorandum of Articles of Association. And you'll be obliged to comply with the ASIC rules because you're structured as a company. Now, regardless of that organisational structure though, you will most likely at some stage have dealings with the Australian Taxation Office. Now, while many not-for-profits don't have to pay income tax, there are a number of reasons why your organisation might require an ABN or an Australian business number and be required to present financial records to the ATO. If your turnover is more than $150,000, you'll need to collect GST on behalf of the government and then return it to the tax office. But even if your turnover is less than $150,000, it might be worth registering for GST because you can then claim back the GST that you're paying to your suppliers. If you employ people and pay them, you're going to collect tax from them on behalf of the tax office as well. So you'll also have to make superannuation guarantee payments, which are also regulated by the ATO. Now, if you have suppliers that are not registered for GST and don't provide you with a tax invoice, then you'll be required to pay withholding tax for business payments to the tax office. So unless you're a very, very small organisation, you're probably going to have dealings with the tax office. So to be compliant, you'll need to have an ABN and keep both your financial statements and the supporting documentation for 5 years. Now, if you're an incorporated association, you'll also need to meet requirements under your relevant state legislation. And you can see we've got those laid out there on the screen in front of you. So each state has different levels of financial records that need to be kept. For example, in New South Wales and Victoria, financial records need to be kept. However, if the turnover of the organisation is greater than $250,000, or if they have assets worth more than $500,000, then the records need to comply with the Australian accounting standards. Now, in New South Wales, they'll be audited, but in Victoria, this annual audit requirement only comes into play if turnover exceeds $1 million. In Queensland, on the other hand, records are audited when turnover is greater than $100,000, which of course means that the Australian accounting standards apply as well. Remember though that even if your state legislation doesn't require financial statements or auditing, your constitution might. So it's important to understand your structure and the legislation and regulatory bodies that you'll deal with to be compliant in operating. But most importantly, from your own perspective, having an understanding of the financial side of the organisation is imperative in maintaining a sustainable organisation that can continue to achieve its purpose in the community. So that's a brief overview of the regulatory framework and of the various bodies that organisations need to comply with and keep financial records for. But exactly what records do you need to keep? So firstly, you need to keep a record of any money that the organisation receives. That's money in. Now, there are lots of ways for an organisation to get income, whether it's donations, corporate sponsorships, government grants, selling goods or services, or fundraising, just to name a few. So the type of information that needs to be recorded is things like, who did you get the money from? How much did you receive? What was the money received for? And when did you receive the money? So for example, let's say on Thursday the 13th of November we received a donation of $10 from Fiona Smith. So the who from in that case is Fiona Smith. The how much is $10. What was it for? It was a donation. And when did we receive it? On Thursday the 13th of November. So these records are often initiated by the organisation issuing an invoice, whether that's for services rendered, for sale of an item, perhaps memberships. And then when the money is received, a receipt may be issued. So these invoices and receipts are the basis of the financial records, and copies need to be kept to support those financial records. Now remember too, when you're issuing an invoice, to include your ABN, as this makes it a valid tax invoice. If you don't include it, businesses can then withhold 45% of the amount of the invoice which they then pay to the tax office. This is known as withholding tax. You would then need to claim it back. So it's much easier for everyone if you include your ABN on your invoices in the first place. And what about money out? Organisations also need to keep good records of the money paid out. And again, this will include details of who you're paying it to, how much was paid, what the payment was for, and when it was paid. Sometimes some of these expenses will need some more information. So for example, when you're paying staff, make sure you keep a record of the number of hours worked, the rate of pay, and the other information that's required for PAYG tax and superannuation guarantee payments. Copies of invoices, receipts, timesheets, all of those sorts of things need to be kept in support of your financial records. And it's not just money in and money out. Sometimes you'll receive donations in kind, that is goods or services instead of cash, or labour will be provided by volunteers, which is wonderful, but it still needs to be recorded. So for donations in kind, records of the goods or services received or provided again should include information like what was it, who provided it or received it, what was it for, when and how much, or what's the value of it. For example, if your organisation has donated a car, how much would you have had to spend if it wasn't donated? And how much might you need to spend to replace it in the future? As for volunteers, we need to keep records of things like how many hours do they work, what do they actually do for the organisation. It's a good exercise to work out if you did have to pay them, how much money would you be spending? This can really help if in time the volunteers aren't available and the organisation needs to employ somebody to do that task or that job. Now another set of records to keep is an asset register. So this is a list of all the things that the organisation owns. Things such as cars, chairs, computers, desks, sporting equipment, that sort of thing. Some of the details that should be kept include what is it? When was it purchased or where did it come from? Its value? Where is it? And when is it likely to need to be replaced? So it's a good idea to do an audit regularly to check if the assets are all still there and working properly. So an asset register helps to plan for future replacement or repairs as the asset wears out over time. Then from all of those records, your money in, money out, donations in kind, volunteer time and asset registers, the accountant will prepare the necessary financial statements for taxation purposes, possibly for audit purposes and for reporting to the board or other stakeholders. But more importantly than for regulatory purposes, the financial statements tell the story about the organisation's financial performance and position. Vital information for those managing the organisation, as it indicates whether the organisation is financially sustainable and will be able to continue to achieve its purpose. The two most common and most used financial statements are the balance sheet and income statement. Now the income statement is sometimes also known as the profit and loss statement or the P&L. So let's have a look at each of these statements and the information that they can provide us about the organisation. So let's start with the balance sheet. Now the balance sheet tells us about the financial position of the organisation at a particular point in time, often at the end of the financial year. It records the assets that the organisation owns and the liabilities and equity that were used to pay for those assets. It's called a balance sheet because of course the two sides must balance. That is, the assets must equal the liabilities and the equity. But let's have a look at each of those elements in a little bit more detail. So assets, of course, is the accounting term for things that are owned by an individual business or an organisation. And in the case of a not-for-profit organisation, the purpose of assets is twofold. They're used to deliver the organisation's service and to provide operational capacity. The difference here is that an organisation may have an office to operate from with a computer communication equipment that provides capacity to be operational. However, their actual service may be delivered via a vehicle, for example, Meals on Wheels. As well as service delivery, an organisation also wants those assets to be assisting in generating more income for the organisation so that they can fund more of the service delivery. Now, in the balance sheet, the assets are broken down into three categories. Current assets are those that turn into cash within 12 months, so things like your cash, your stock, and any debtors the organisation might have. Fixed assets are those that last longer than 12 months, things like motor vehicles, computers, desks, chairs, etc. And then thirdly, intangible assets are those things that you can't touch or feel but add value to an organisation. So things like goodwill, licenses, patents, or intellectual property. The other side of the balance sheet, of course, is the liabilities and equity. Now, liabilities and equity are the sources of money to pay for the assets. Equity is the organisation's own funds, while liabilities are the money owed to other businesses, organisations, or financial institutions. Again, the liabilities are broken down into current and fixed, with current liabilities being those that need to be repaid within the next 12 months. Things such as any creditors or short-term loans like credit cards or overdrafts. Long-term liabilities are those that will be repaid over a longer term than 12 months. Things like equipment finance or building loans. And then equity, as I said, is the organisation's own money. Perhaps starting with some initial seed capital or an initiating bequest, and then it's added to annually by any profits or surpluses that are made by the organisation. So let's have a look at an example. So we can see here that this particular organisation has a significant amount of cash and some stock as their current assets. Some office equipment and vehicles as their fixed assets, all totaling $355,000. So as you can see, there's an equal amount of liabilities and equity, which is then broken down into current, being their credit card and creditors, a long-term loan for the car, and their equity. So this is the summation of their financial position at this point in time. Now let's have a bit of a look at the income statement. As I said, they could also hear it referred to as a profit and loss or P&L, or even the statement of financial performance. Now, the income statement collates all of the income that the organisation has collected, expenses that it's incurred, and calculates the surplus or deficit over a period of time, again commonly a financial year. It's useful to further break down the expenses into those incurred through actually providing the service and those necessary purely to be operational. So as an example, if the organisation is one that provides helicopter transport service for people needing medical care, the types of expenses that we might incur purely to be operational are things like our communication systems, insurances, and equipment maintenance. However, the costs we incur in actually transporting a patient or delivering the service might be things such as fuel, the pilot's wages, and air traffic control charges. Our aim, of course, is to use more on service delivery than on operations. However, as we know, this isn't always the case, so it's a good idea to keep a good eye on it. Now here's how a typical income statement might be set out. So this organisation's received an income of $240,000 over the financial year, being a mixture of grant funding and fundraising. They spent $230,000 on a variety of expenses there, leaving a surplus or a profit of $10,000. So the balance sheet tells us about the financial position of an organisation at a specific point in time, and the income statement tells us about the financial performance over a specified period of time. Now, useful information in both cases, but it's when we look at the two statements together, not in isolation, that we get a more complete picture of the financial operations of the organisation. So our first step here is to understand how the financial operations of an organisation works, and to demonstrate this, we're going to have a look at a model that's known as the financial operating cycle. Now this cycle operates in every business or organisation, no matter the size or the industry. So when the organisation was originally established, funds would have been made available in one form or another, and this is the original equity of the organisation. If this wasn't enough to get started, the organisation may have had to obtain some stock on credit or borrow from a financial institution to top up that equity. And this, of course, is known as liabilities, or as I call it, the other people's money. So then with our money, the equity, and the other people's money, the liabilities, the organisation uses those funds to purchase the assets they need to operate. As we saw, this can be assets like vehicles, equipment, all those sorts of things. Now these assets are then used to provide our service and to generate more income or revenue. Now as soon as we begin operations, we're going to start to incur some expenses like wages, electricity and so forth. At the end of the period, if we've managed this process well, we will have a surplus. Now this surplus is then retained in the organisation as equity and used in two ways. Firstly, it's reinvested in assets. Now that might mean it's saved as cash, we might purchase some more stock or another piece of equipment, things like that. Well, the second use is to reduce debt. Now the key to long-term sustainability is to keep this cycle turning over smoothly and efficiently. We want to efficiently be using our assets or resources in providing our service and generating more income for ourselves. We want to efficiently be managing our expenses to provide as much of our service as we can with the funds available. Then efficiently be using any surplus to reinvest in the organisation to either reduce the risk and costs by reducing debt or to increase our outputs or grow the organisation by reinvesting in assets. Now this model also demonstrates that relationship between our financial statements. So assets equaling liabilities plus equity, of course, is our balance sheet. Then our income less expenses equals surplus is our income statement. But what we can clearly see now is that there's a relationship between the two, and that what happens in the income statement, that is our financial performance, is going to have an impact on our balance sheet, our financial position, and vice versa. So to have a complete picture of the organisation's financial management, we need to be able to read and understand both. Now just before I move on from this model, I just want to make one more final point here. Now the model shows us that any surpluses are reinvested in the organisation and used in those two ways. But what if the organisation makes a deficit instead of a surplus? This would then indicate that the organisation would need to either borrow more, which for many organisations isn't actually an option, or would need to reduce its assets. And a reduction in assets, of course, often means a reduction in our ability or capacity to be able to deliver on our purpose in the community. Not a position any organisation wants to be in, so let's avoid that one if at all possible. So as I said, the key to long-term sustainability is to keep this cycle turning over smoothly and efficiently. But how do we measure that efficiency? We use something called financial ratios. Now these ratios simply compare one number with another, which tells a story about the organisation. For example, the reason an organisation owns assets is to provide their service to the community, provide operational capacity, and in some cases to generate more income. So to measure how efficiently we're using our assets in generating more income, we compare the value of the assets with how much income we're generating. The income to assets ratio tells us that for every dollar that we have invested in assets, the organisation is generating X amount of income. Now if this ratio is declining, it could be indicating that the organisation is being less efficient in the use of its assets, which then allows the organisation to investigate why. Perhaps equipment is ageing or not being operated efficiently. Perhaps the merchandise is not being priced well. Or it may be that interest rates are declining, so invested funds are not providing the same return. Whatever it is, by identifying that the asset efficiency is declining, the organisation has the opportunity to do something about it. Now, another useful measure of efficiency is to look at what percentage of expenses is spent on operations and what is spent on service delivery, as I mentioned earlier. The aim of most organisations, of course, is that the majority of their spending is on service delivery. So having an understanding of how operational costs might be impacting on the organisation's ability to deliver on its commitment to the community is absolutely critical. So efficient management of income usage is also a factor seriously considered by stakeholders, such as sponsors, donors, or even investors, as they want to ensure that their contribution is having a positive social impact. So having a good understanding of both your operational costs and your service delivery costs makes it easier to know when you need to attract more funding or how much more of an impact the organisation can have with increased funding. Now, the final ratio I want to touch on today is the return on equity. However, not so much in an investment sense, but in how efficiently surpluses are being generated to provide future funding, to either, as we said, grow the organisation and its social impact through reinvesting in assets, or improving the organisation's sustainability by reducing liabilities and risk. Now, this is partially why I prefer to refer to organisations operating in the social sector as profit for purpose rather than not-for-profits. Because as funding becomes more limited and difficult to produce, it's becoming much more essential for these organisations to become more self-sustaining through generating their own surpluses. So wow, in our short time together today, we have looked at the regulatory framework in the social sector and why it's important to keep good financial records. We looked at the type of records that need to be kept, and then at the financial statements that are collated from these records and what information we can glean from them. So our organisations might exist for a social purpose, but without good financial governance, the organisation's ability to achieve that social purpose is reduced, if not jeopardised. So ladies and gentlemen, that actually brings me to the conclusion of the formal part of the presentation. So what I'd like to do now is just check whether any of you have sent any questions through for me. So just bear with me for a moment while I open up my question panel here. So I can see here, I've got a lovely long question from Karen. Just give me a minute while I read through. Karen, very good question. So just for everybody else's benefit, Karen's question is, I'm the treasurer for a community health group who support financially the running of our health centre. Our group fundraises and purchases medical items to be utilised at the centre. So my question is, how does our incorporated group show on our records the items that have been purchased and then donated to the clinic? So let me get my head around this one, Karen. So your group fundraises, so you will have income from your fundraising. You will then use that income to purchase the assets, which you then donate to the other organisation. So there's probably a number of ways that could be done, and given it's such a specific question, Karen, I might actually take this one offline just to make sure I've got my head around it properly too, and I've got your email address there from your registration, so I might converse with you via email this afternoon if that's okay. Tina's sent through not so much a question as a comment. Enjoyed the overview of financial concepts and financial governance. Thank you, Tina. But ultimately, to have a good accountant to assist with the financial side of the organisation is, yes, very, very important. I've got a request here from Anne for eligibility for DGR status. In a future webinar, I'll certainly have a look into that, Anne, and if we can bring something like that to you, we will. And Rosie's sent through What to do when there is poor financial records from previous treasurers in previous years. Yes, I think a fair number of us have possibly been in that situation, and Rosie, my advice there would simply be to get on top of it as soon as possible. Get help from your accountant if you can to go back and perhaps reconstruct those records, but certainly get on top of where you are at right now as soon as you possibly can. So yeah, in that case, it really is do as much investigation as you can about the past once you've established exactly where you are right now. And an accountant, and if you can find one that will work pro bono, would be a very big asset to help you with that. Okie dokie. And it looks like there's a little conversation going on there between Rosie and Tina, which is absolutely brilliant. Love to see the interaction from everybody there. Question here from Anu, will the presentation be available with recording on Ruby? So I'll send everybody an email this afternoon that will actually include a link to a pre-recorded version of the webinar that sits on the Davidson Institute website, and then within about 4 or 5 working days we'll then be able to have the recording of this particular webinar available as well. So, and at that stage I'll email everybody a link to that too. And a good tip from Amanda here to I think Rosie had the question around previous treasurers, would suggest that new office bearers, if in doubt, get a pre-takeover audit completed. And that's a really great suggestion, Amanda, so thanks for sharing that one. Well, all right, our spate of questions seems to have slowed down for the moment, so I might take this opportunity to say thank you all so very much for joining us for the webinar this afternoon. As I said, later today you'll receive an email that contains a link to download a summary and also review a recorded version of the webinar if there's anything that you want to review. So I trust you found today's information useful and relevant, and that you'll be able to use it to make more confident financial decisions in your organisation. Now I also hope you'll join us again next month when we're going to have a look at getting started in business. So many of us have entrepreneurial tendencies, but to make those dreams come true requires some real determination and grit. And our webinar will look at the basics to help make your vision your reality. So I hope you'll join us then, and thank you very much for joining us today, and good afternoon.